Hello and welcome to the Accredited Investors Only podcast presented by Accredited Life. My name is Peter Neal. I am the host of the show. Welcome. Thank you so much for joining me today. We have a great episode for you with a very exciting interview. Before we get into that, though, let me ask you, are you living your accredited life? I think it's so important to take time each day and ask yourself, am I living the life that I want to be living? Am I doing the things that I want to be doing? Are the actions that I've taken today, are they bringing me closer to where I want to be? Are they leading me down the path that I want to go down? Or are they taking me further away? Or are they kind of have me in a state of, I'm kind of going nowhere necessarily? So I always think it's important to ask ourselves that question each day. And take time. This, as I'm recording this now, it's a little bit before Thanksgiving, so everybody will probably be having a couple days off, traveling, seeing friends and things like that, and maybe taking some time away from their 9 to 5 and their job and that kind of stuff. And maybe sometimes time like that where you can slow down. This will probably go out, after the holidays and all. But it just because, I think times like that you have to yourself maybe and away from work and things like that where you can maybe take the time to think about certain things and all. But even during just the regular hustle and bustle, I think it's very important to schedule time aside whenever you can. If it's early in the morning, that's great. There's no distractions of life and kids and work and family and friends and stuff like that. Or maybe it's at the end of the day when everyone goes to bed, you stay up for an extra few minutes just to think and have some time and be present with yourself. And it's go back and listen to some of the earlier podcasts where I talk about building your foundation and things like that. If you've done that, that piece is already in place, and you can ask yourself, and you looked at your goals and your vision and all that kind of stuff, and you take time to ask yourself, are you living your purpose? Are you working towards it or against it? That kind of thing. So I encourage you to take time today to ask yourself, are you living your accredited life? And are you doing the things that are leading you closer, or are you maybe a little bit stagnant, or maybe you're heading in the wrong direction completely? And ask yourself why. Constantly be asking yourself why and questioning, and if you need any help or need somebody to talk to or something like that, always feel free to reach out to us and myself, and I'm happy to talk to you and try to find ways to help bring clarity and focus to your life and your investing. So that's just my 2 cents for the day. As I said before, we have a very exciting interview planned for the episode today. We're going to be talking to Drew Wahlgren. He is the Vice President of Capital Markets at MAG Capital Partners. So he oversees both the equity and the lending relationships for MAG Capital Partners. He joined that company in 2019 following a successful 8-year tenure as a risk analyst and program manager at Liberty Mutual Insurance, Liberty Bibbity. Mr. Wahlgren holds a bachelor's of science degree in finance from California State University at Hayward, and he resides in Dallas-Fort Worth metro area with his wife and his children. He enjoys spending quality time outdoors and with the family. Don't we all? So we have a really great interview lined up today with Drew. And we're going to talk about MAG's strategy. I love their strategy. It's a single-tenant net lease industrial strategy, great for cash flow. So he's going to get into why they're focusing on that, the funds that they've created to acquire those types of properties. One thing that's different, if you're used to residential, on the industrial side is how he analyzes the companies that are leasing the industrial buildings that they're investing in. So that's an interesting part of it as well. So great interview lined up today. Check it out right now.
You're listening to the Accredited Investors Only podcast, presented by Accredited Life.
All right, Drew, welcome to the show. How you feeling today?
Oh, amazing. Good to be here. Nice to be with you, Peter.
Definitely. Nice to have you. So where are you from, Drew?
I live in Fort Worth, Texas, right here, DFW in the metro, and our company's home office is right here in Dallas. and originally from the Bay Area. So a transplant like many other Californians.
Oh, really? Okay, that was going to be my next question. Were you born and raised there? So when did you come to Texas, and what brought you there?
It's been a little over a couple of years, really lifestyle change with the family, 3 kids, and we were sort of a dual income household, and we said, let's change that. I'm flexible. I can do my work from pretty much anywhere, but I love to be in a big metro, and our home office was here, and a lot of our team that I'm close with is here. So kind of a start of a network, right? And so, yeah, now my wife's home with the kids. She loves it. And, maybe at some point she goes back into her entrepreneurial world that she came from. But in the meantime, we're just, engineering a lifestyle that's perfect for us and our family. So it's been great.
That's awesome. Well, yeah, engineering a lifestyle is that's a cool way of putting it, and I think such an important thing for accredited investors on their journey of financial freedom and beyond. I think that's a good way they should look at their investing, on how it's engineering their lifestyle and towards how they want it to be, that kind of thing. So, talk to me about MAG Capital Partners, what the company does, and then we'll get into what specifically you do at MAG.
Sure. Yeah, Mac Capital Partners, we're a private investment shop. We've been in existence as this team that's grown over time for 10 years now. And today we're 23 of us strong. So still small in a relative standpoint, but it's fairly robust, I'd say, in comparison to a lot of small shops with just 2-3 people out there that I've seen operating very successfully. No, don't get me wrong, but at our size now, we're managing a little over $1 billion in assets under management. So requires a full team, very vertically integrated here. So manage in-house accounting, finance controller team, construction facilities management, capital raising. So asset management, of course, and even credit analysis, which we'll get into. But we've had a focus for a long time on single tenants, net lease, industrial real estate. Primarily with these facilities and long-term leases backed by U.S. manufacturing companies. So that's really been a focus of ours for a long time. We're long-term holders. We design investments for cash flow and gradual appreciation over time. And it's been a very nice conservative investment strategy that's really held nice and strong and steady through even the interest rate environments that we've been in, and hopefully we'll continue to run strong through the eventual recession, right? Whether that's next year or 5 years from now, who knows?
Or we're already in the middle of it. It depends on who you talk to, right? You get a different kind of story. And that's very interesting. I coming from the workforce and affordable housing space, you think of the demand in that type of real estate, creating a recession resilient environment. And I think you make a really good point. Industrial is the same way, especially depending on what type of industrial you're in. So for the viewer that maybe industrial is new to them, get a little bit. You said single tenant net lease industrial. So there's give me like just a kind of just to paint a picture mentally of what a building will typically look like and what area it's in and all that kind of stuff. Just kind of paint the mental picture for me, Drew.
Yeah, and I'll start just kind of how I look at industrial real estate in general is almost every industrial property falls in one of 3 categories. Flex industrial, which is really your multi-tenanted small bay industrial. Some people call that a little bit of office space in each one, some storage. Typically, shorter term leases, right? 3 to 5 year leases. They're not triple net. Generally speaking, there might be single, double, triple net. There's all kinds of shades of gray of net leases, of course. But yeah, I mean, you imagine Joe the plumber, right? He's got a fleet of 4 vans and he's got all his parts and equipment there, and he needs a place to store it. And he just needs, 4,000 square feet, right? And that's a perfectly good industrial strategy. The other stuff you see out there, the big box stuff, a lot of the stuff you see built along highways and absolutely massive properties, 1,000,000 square foot properties. Those are warehouse and distribution centers usually. And 3PLs, as they say, third-party logistics centers, where they're working with a variety of companies to take shipments in, store it, facilitate loading trucks up by one pallet or full truckloads out. And then there's manufacturing. Outside of those 3, there's a few specialty things out there, right? There's, lab, R&D kind of applications. There's special use, which I kind of put in its own category. You're talking about like a foundry or something, right? Chemical manufacturing plant where you just see a bunch of silos. It's not exactly the big square box that we typically see in our world, but yeah, the manufacturing is right there, and that's really the place that we're in. And it looks a lot like a lot of the 3PL sites, but usually a little bit smaller in size. Anywhere from 50 to 500,000 square feet. And honestly, inside they look very similar to a 3PL site. They might not have quite as many dock doors. They might be 20 to 30-foot clear heights, where all the new 3PL stuff is typically, they want 40-foot clear heights. They want to stack these racks all the way to the ceiling. I mean, that's some new premier class A kind of stuff that, Amazon will use and have, a whole maze of, robots and conveyor belts and all the stuff so they can work that efficiently. But yeah, we fall in this space, and our typical tenant is a privately held manufacturing company. Most of them are really well tenured, anywhere from, 30, 40 years up to 100 plus years in operation, manufacturing widgets, parts, sometimes food production or food packaging. But most of these are in parts manufacturing, right? So you might have someone that manufactures, chemical coatings, or it might be aluminum gears and sprockets. It might be styrofoam, expanded polypropylene for insulation purposes or packing materials, whatever that might be. So it's basically B2B sales, right? And you see these operations. I mean, you might, frankly, if you drive through a lot of these industrial zoned areas, you really don't know what's being manufactured, right? Because you see a sign and it says,
Sure.
X10 Holdings, and you're going, I don't know what that is, right? But inside, they might be manufacturing axles for school buses, right? It could be as specific as that. And here are these companies that manufacturing, again, stainless steel tubular components for a variety of industries that are just quietly doing 150 million a year in revenue, nice solid margins. They might be on the outskirts of a secondary market, right? They're just right outside of Minneapolis, 30, 40 minutes from downtown. And that's where you see these companies set up shop, right? They're a little bit margin sensitive. They can't be on Main and Main downtown. And that's not where they want to be. They just need access to labor, transportation. And frankly, most of these guys are shipping out product to a large region or across the country, maybe even globally. So really just need access to transportation to get the product out.
Yeah, Drew, you bring up a really good point, because that was kind of my introduction to industrial and walking through tons of industrial properties over the years, where just blown away by what the tenants are doing and the businesses they're operating. I think with residential, multifamily, single family, so you can envision the family or the couple or the students or whatever it is that are living there. But with industrial buildings, the average person probably can't even imagine all the different types of industries and what they could be manufacturing and things like that. That's a fascinating side of the business. So talk to me about like the average deal. Are you guys buying something that has an existing tenant in? What is that lease? What's your buy box? What does a normal deal look like? What's the ideal deal look like? And then I'm sure it varies, right?
Yeah, it's really interesting. The most interesting part of what we do, in my opinion, is our specialty is sale-leaseback transactions.
Okay.
Yeah, 95% plus of our acquisitions are sale-leaseback transactions where we are buying the property from a owner user, right? Joe's Manufacturing, whoever it is, they've been there 20 years in this particular facility, and they're selling the property, but they are not moving out. And simultaneously at closing, we're signing and executing this very long-term institutional grade lease, 15 to 20 years, absolute triple net leases. Really, that's our gold standard. We'll get back into that in a minute, but we're following many times behind M&A transactions. Private equity group comes in, buys company 2, 3, 4, 5, whatever that is as part of a platform or a fund that they manage. And they don't want to tie up capital in real estate, right? They manage, just like a lot of real estate and investment managers. They might have a fund with LPs, right? They're passive investors, and they have a mandate, right? We're here to buy operating companies. Many times that purchase comes with a real estate, and so we're basically a real estate partner to them. Sometimes as they're acquiring the business, and sometimes it's years later. But they're saying, look, we want to free up this capital here, either to, add acquisitions, sort of lower our basis, again, or just keep our money out of the real estate because we can't do that. Or it might be years later, like I mentioned, where they say, okay, we want to take this company to the next level. We've performed A, B, C, and D, companies doing great, but we want access to capital. So this is a financing instrument for a seller. They're going, look, I have alternatives. I can go to a bank and get a senior loan. There's going to be a rate there that comes with it. And there's going to be, many pages of covenants that also come with that. And so this is another alternative. So for many of them, they like this, part of which is they don't put leverage on their balance sheet, right? So it's according to modern day GAAP accounting rules, rents is a footnote, right? So if they're looking at leverage ratios, for instance, maybe they have a piece of senior debt on there and they go, well, we could free up $10 million capital here, and it doesn't put additional leverage, doesn't affect our debt to EBITDA ratio, whatever that is that they're trying to balance out. It's very flexible capital for them. And usually it's much cheaper than a senior loan that they would get. It's just not the same rates that you see with real estate. You first position debt, there's not the same kind of collateral usually, right? There might be some collateral, but frankly, the rates tend to be in the, today, 8 to 14%, if you want to go get a loan on your business, right? So it's a little different. And now you start to look at what kind of cap rate, their effective payment on that loan, if you will, or that capital that they're freeing up. And you can see that it's a lot cheaper there. So that's our typical deal and how we're acquiring them, and really has become a specialty over the long term. And we've gotten to know these PE shops, and many of these acquisitions we make are sort of repeat business, right? It's a new tenant, but private equity sponsorship that owns it or is now acquiring that business. And usually they're sophisticated operators, and then we dive in heavily in the due diligence of the tenant.
Yeah, well, that was going to be my next question. Yeah, because I think that's another part of the industrial real estate space that makes it just a lot different, is due diligencing the business along with the building and all, who the business is, the credit worthiness of it, that's signing on that lease. So talk to me a little bit about that process.
Yeah, I mean, we look a lot like a private equity shop when we're in due diligence, right? We're looking at this company almost as if we're buying it, right? We want to know everything about them. We talk to, the whole C-suite. There are many, many hours of phone calls with the management team at each one of these tenant companies. As we're in due diligence, we really want to understand, hey, where have you been? Where are you going? Look at the competitive landscape. Look at the industry as a whole, right? Is this an industry that's here to stay? Or are these dinosaurs that, is this a Yellow Pages, book manufacturer? Believe it or not, I looked at a deal years ago that was that. I couldn't even believe they were still around. Or is this such new tech that this could be a fad, right? Could these guys be in and out? But again, most of these are super well tenured. Give an example. We bought a company in December of last year. Company manufactures gravestones and headstones. And you go, okay, it's a pretty good industry to be in. We're all going to kick the bucket. So as you dive in closer and you start to realize, hey, some people are cremated, and there's actually an upward trend in cremation. Okay, there's a risk, right? You start to look at that, but you also look at another 20 years in front of us as the baby boomer generation will be passing on as well. Huge wave, people talk about the silver tsunami, being a good thing for retirement homes. Well, what about after they pass on, right? There's going to be a lot of demand for gravestones and headstones. So we don't need them to 10x their size, but we do need them to pay rent, right? And we want to see stability. And if they're relatively flat or growing at a slow organic pace, that's fine. We like that. Seeing many companies that you go, look, they're very conservative and shrewd. They don't want to over lever, and thus they grow a little slower, and that's great, right? That makes her a really strong, stable tenant. All that is the nuanced stuff. The obvious stuff is spreading the financials, of course, and looking closely there. And again, debt. How much debt do they have on their books? And what kind of margins are they producing? Are they seasonal? How are they protecting themselves from, if they're using steel, what kind of contracts do they have there? If the price of steel goes up, what kind of exposure do they have there? So we built our team around this. We don't look like your average, residential real estate investment shop, because we have a team with, I call it 4.5 and aspiring credit analysts on there too. But these guys are, the top two guys are 10 plus years institutional experience of corporate credit analysis that they've had from publicly traded REITs. And we brought these guys and continue to build that team. So we have a robust credit analysis process, and we generate credit memos internally and really document that well. And it's huge kudos to these guys. we've had well over 100 single tenant properties. We've only had one tenant ever default in the course of that time. So they've done a great job.
Wow, that's amazing. What's a lease typically look like? You said 10, 20 years. I'm guessing there's increases built in, all that kind of stuff. Just talk to me about what a typical lease looks like.
Yeah. Great question. 15 to 20 years is what I say, honestly, are 20-year leases. They're absolute triple net in turn. So people talk about triple net a lot, right? And it's sort of a category of real estate that people talk about. Usually it's QSRs, right? Basically fast food restaurants, Wahlgren just come up a lot there. But yeah, the absolute triple net really means that everything from fence line to fence line is a responsibility of the tenant. So average triple net does not include roof and structure, not include HVAC systems. What about the parking lot, right? So there's everything falls on the tenant. And sometimes people ask, why would they do that? And there's a trade-off, right, on rent. Rent's going to be a little lower. But what we love about that is we're not underwriting for reserves, which are always an assumption, right? When you have gross leases, I mean, and you're underwriting, you're going to make a lot of assumptions. You're an accredited investor, one of your listeners, and you're looking at these deals, you have to look at that and go, is this a reasonable assumption? Is this conservative or is this too aggressive, right? They say their insurance premiums are going to go up 2% a year. Probably not reasonable these days, right? I mean, they've tripled in the last 3 years. Who knows, right? In certain regions of the country, at least. But we're able to take all that off the table, right? So we can go, look, our rent actually equals NOI, which is, sometimes surprising to some people, but there's truly no exposure to expenses there. So what that makes for is this really predictable cash flow, right? I know exactly what I'm getting in rent. I got 100% occupancy for long term. I have no exposure to expenses. And, I'm sure we're going to circle back on this, but we're using fixed rate, long-term fixed rate financing. So I have a lot of fixed inputs that I know, right? And really, there's only two assumptions we make in our underwriting, right? One is that the tenant remains solvent, pays their rent, and then the other is the exit cap rate. We don't know what price we're going to sell for. No one does. Everyone makes that assumption, and you just have to be conservative there and realistic, of course.
So give me what areas do you guys invest in? Is it all in Texas or is it throughout the country? Or
Yeah, no, I'll come back to geography. I totally left out a couple key things though. The leases have annual rent bumps. So
I was going to ask you that too. Yeah. So annually it built into the lease, it's pumping.
Yeah, 2.5%, 3% is pretty typical for what we see out there.
Sure.
But we're on the front end of this lease. We can craft this lease how we see. And, maybe you got a deal you really love. The basis is great. The credit of the tenant's fantastic. It's just a little thin. You might say, okay, we're going to, let's have 5% bumps for the first 5 years. Let's kind of build out of that, right? It's almost like a more aggressive value add almost baked into this lease, right? So that's nice to see. Again, 5% NOI growth. I mean, any real estate investor is going to love that. But you might, push for that if you go, look, this deal just, this cap, unless we can get a higher cap rate, it doesn't work. And maybe they need certain proceeds or have certain requirements around their rents. You can start to negotiate with the tenant in that way and say, hey, can we bump it up a little faster, at least for the first 5 years? But, these guys like the long-term leases. They're okay with the annual rent bumps because usually they're pretty conservative. And frankly, they want to be there for the long term. Otherwise, they wouldn't be signing this long lease. And they're giving themselves a lot of protection, right? If you sign a 5-year lease, you don't really know what's going to happen at the end of that 5 years, right? You might have a huge rent bump, right, that you're looking at. So these guys are paving the way for some predictable overheads so they can continue to grow their business. But one last thing on the leases is we require them to report financials to us in the lease. And that's a very institutional lease reality. And we know that, hey, if you want to sell to a big public REIT, they're going to require that. But it's not only for that, it's for us to mitigate that risk as well. We can monitor them. And if you're seeing some negative trends, compressing margin, declining revenues, obviously you're going to want to talk to that tenant and say, what's happening? Can we work with you? Can we help you? Let's look a little closer. And if it looks really helpless, like they're going down in flames, a slow, agonizing death, you might want to start, thinking ahead, right, about what we can do, or maybe even help them, right? Hey, I always want to help out a company, but can we consolidate you? Can we bump your rent per square foot up a little bit? Maybe put in a partition, bring in another tenant to take the other half, right? There's a lot of things you can do, but you hate to just kind of wring every last dollar out of them until everyone's out of a job, right?
Sure.
So, but yeah, again, they're going down. You might say, okay, look, we can start looking for a new tenant. We can start making these plans ahead of time, start looking at maybe what this would get in the marketplace if we sold it today, right? There's all kinds of opportunities you can take on. But going to your other question about location, we can afford to be agnostic because these don't require boots on the ground. It's day-to-day leasing activity. They're very, they call net lease industrial or every kind of net lease and real estate mailbox money, right? We periodically send in third-party property inspectors, or we'll go out ourselves just to kind of look. But we're talking about every 18 to 24 months, right? You don't need to have people there all the time. And it's really just to make sure that the tenant's fulfilling their obligation because they're responsible for upkeep of the property. And anything less than that is a breach of the lease, right? So, we're investing all over, but long story short, we're going where the opportunities are. We're underwriting them when we see the opportunities as far as, location and city and market, and of course, heavily on the credit. But where you find a lot of that is where manufacturing has been for a long time, which is the Midwest, right? I mean, that's, traditionally been the Rust Belt. There's a lot there. There's a lot in the Southeast as well. Tennessee and Georgia have been incentivizing a lot of manufacturing there with state tax credits and things like that. But of course, Texas and our home state here. But yeah, we have a national portfolio.
Okay. What's the building typically like, or like when were they developed? Is there any initial cost that you need to spend in order to get it to where you want to be, or is that through the tenant, or is it negotiation, or what does that look like?
Yeah, typically the buildings are, I call it B class, very rarely, but sometimes you go, look, the basis is right. And this might be, C plus class, and that's fine. Right. Again, this is a very utilitarian piece of real estate for the tenant. And these properties, we bought some older stuff and you wouldn't guess it. Because, metal buildings, especially, they get renovated every 15, 20 years. And what do, they put new siding on it, new roofing on it. Occasionally they redo the bathroom in some of the office. But it's fairly, it's not a huge undertaking to renovate these properties. And they need to get done again, 15, 20 years, especially in the Rust Belt. It's part of the reason they call it that, right? There's a lot of corrosion sometimes on these, but, also buy some tilt wall construction product, where they concrete walls or concrete block construction. But there's a lot of metal buildings out there, and that's pretty common in industrial manufacturing. We like the space. We can get a lot of below replacement cost real estate in this, second generation properties, right? Where, hey, this is, 20, 30-year-old building on this property here, but, hey, these guys are going to be responsible for the upkeep. And you look at replacement costs for a metal building, it might be 125 to 175 bucks a foot, kind of depending on the market. We're usually buying in the, $40 to $90 range, for the most part. Right. And obviously you get to some more primary markets, it gets a little higher, but, below replacement costs is a nice thing to have. And especially if we ever see, which I don't know if we're going to see any kind of weakness in industrial for a long time, but, if we do, a lot of this newer construction commands a very high rent.
Sure.
Right? And you're building the big 40-foot stuff that I was talking about. That's $300 a foot to build. It can vary by market and developer, of course, but what kind of rent do they command and who can pay that rent? It's usually going to be, a blue chip tenant only. And you're going to have some other middle market companies, like a lot of our tenants, who are going to go, yeah, this is too expensive overhead for us. We have to walk margin. And so we like this space where we can have a lot of applicable tenants that could take the property on should we run into a vacancy.
Yeah, that's amazing. So how after COVID in the Philadelphia market, industrial has been white hot, and I think it's cooled a little bit, but cap rates certainly suppressed, and it's everybody that owns an industrial building had caught on to just how attractive they were over the last couple of years. How are you guys seeing that in the markets that you're in? And was there a time where maybe you took the foot off the brake a little bit, or or you put it on a little bit, or how have you navigated the last few years?
Yeah, when COVID happened, it was, I don't care what asset class you're in. If you say you weren't a little scared, you're lying. If you're looking around going, I don't know what's going to happen, right? And we, owned a manager portfolio at that time, and you started to realize, you talk to these manufacturing companies, they're going, hey, we're allowed to continue to operate, right? We're not customer or public facing company here, and the guys on the manufacturing floor, maybe they got to wear a mask or something. But that was great news. It was really nice to see. And you go, look, all these properties are continuing to operate. They're paying rents. You get on the phone, you call the CFO, your tenant, and, you're on a pretty good basis with these guys, right? You do a sale-leaseback and you become their landlord. It's a long sort of partnership you have with them. And yeah, it's a great thing to hear. Hey, we're operating. And by the way, we still have $15 million of cash on our balance sheet. You go, okay, this, you start to realize, hey, these guys, I don't think we have anything to worry about so far. So yeah, we did really well through that. And yeah, industrial real estate, I mean, everyone kind of focused on post-COVID, but it was doing better and better pretty much every year since like 2010, right? And I know every real estate did better since then, but you saw a lot more manufacturing jobs coming too. But also industrial real estate from the 2010 to 2020, that decade before COVID, e-commerce was really fueling a lot of growth there, right? I mean, that was a huge growth years for e-commerce where, Amazon's doing its thing and everyone's setting up an online store. And so you saw this over time, more 3PL sites, as big warehouses, or even, medium and smaller ones supporting, maybe last mile delivery. And you just needed more and more of it, but it was a more gradual growth. And then COVID happens and things go nuts. They skyrocket. I think pre-COVID, e-commerce was a percentage like 9-10% of total retail sales. And then COVID happens. I think it peaked out. Some people say as high as 25%. Or more. I've seen some numbers there, somewhere up in there. And then it kind of settles back down, right? Things start to reopen in different states and areas, and then others a little later. But you see that kind of come down. And then what we've actually seen the last couple of years is it tick back up, right? There was kind of a move back to brick and mortar. And then now you see e-commerce coming back up. And why is that? It's really just continued new technology, right? I can go get groceries now on my phone. Right, that's pretty cool. Well, that's held in cold storage industrial somewhere. And that's being taken right from there or from the grocery store maybe. But a lot of this is being supported by industrial distribution centers. So that's been a key driver for a lot of this, even outside of the manufacturing and the onshoring we're starting to see now, which is a totally different subject. But really quickly, I'll say, when you look at the trend line of e-commerce, like I was mentioning, of a percentage of total retail sales, you see that blip up from COVID, and then it kind of goes down, and then it starts back up. If you take out that 2-3 years there after COVID, the line is perfectly flat. It's very gradual. So I don't know when that'll plateau or stop somewhere. I mean, you're not going to be able to buy everything online, but maybe. I mean, who knows? The world would be a lot different for us all in 20 years.
Sure. No, that makes a good point. So I want to get to the opportunity to invest with MAG, but before that, one other question, kind of operational, acquisitions. Talk to me about that. Are you guys doing that in-house? Are you working with brokers? Are you going right to private equity? You going right to owners? What does that look like?
Yeah, I mean, 90+% of these opportunities are going through broker houses. They control most of this. And, look, they do certain things really well, and especially with sale-leasebacks. A lot of these broker houses, they have teams of guys picking up the phone and calling every private equity shop, every manufacturing company in the country saying, hey, have you thought about a sale-leaseback, freeing up some capital to grow your company? And they're generating transactional business, right? And so they do that very great. We don't have a team of 100, call center.
Not knocking doors. That's one of the rare commercial investments where you can knock doors and maybe actually talk to an owner. Usually you go to an apartment complex, the owner's not going to be on site, but with an industrial property like that, chances are the owner could be there in his office and might talk to you.
Yeah. And I mean, you develop a reputation in the business and sale-leaseback specifically, which we do have a lot of rep in. That goes really well with the brokers. We always say we know every single broker in this space and they know us. And, and frankly, it's probably true, right? There's not that many of them across the country in this very specific space. But, over time, I'll have a loan broker, for instance, will go, hey, I met this guy, he's got a business and he said he wants to sell the real estate, but he doesn't want to retire and sell the business yet, but he just wants to free up some money. And so they'll make an introduction and there you go. We've got some off-market deals. So it does happen. But generally the brokers do really well there. And again, this relationship we have with them is way more crucial than I think a lot of people think. And a lot of that's because of how crucial the execution is of this transaction. So private equity shops going, hey, we need this thing done in the next 3 months, right? I don't want to screw around with the highest bidder and then find out they were, over their skis. They couldn't get the financing, the equity, and the whole thing falls apart. It's a huge headache for them, right? They have business to do, and proceeds are important, right? They want to get a good price, of course, but more importantly, they need to get it done. And so our reputation with that community is that, hey, for a certain segment, for a certain buy box, we can get it done with really high reliability. And it's a sophisticated transaction, right? You got private equity sponsors, you got tenant management. Sometimes you got some of that moving around during the transaction. Sometimes we're doing it in tandem with the private equity acquisition of the company where, we're a small part of a big transaction, but need to execute on their timeline, right? So you can imagine there's a lot of, it can be a little stressful, but yeah, there's a lot of pressure there to perform and get it done right. And understand all the nuances in the lease. So they want someone who's done it before, in other words, and someone who can get it done. So we win a lot of deals that way, and we're boutique and nimble enough to not have to worry about multiple layers of committees that can shoot these deals down. And we've seen big shops. Morgan Stanley as a net lease team, JP Morgan as a net lease team. Angelo Gordon, Stag Industrial, some of these big public REITs, right? They have big teams, and sometimes you can have an acquisitions team that brings it to the table and it gets shot down at committee, and there you go, the deal's dead. And now the seller's going, who else, right? We just needed to get this done, and now we burned 60, 90 days. So they'll come back to us and say, hey, is your offer still good, right? Because these guys will blow us out of the water once in a while, or many times, I should say. And at the end of the day, they just need to get it done. So that's really nice to see. We can win these deals over these very institutional buyers.
That's amazing. Which kind of leads into my next question and what I was talking about before. So what's the opportunity? How do you work with accredited investors? And then we'll talk about the capital stack too involved with it.
Yeah, we manage several funds. Really, they're very simple as far as the capital stack goes. We do use first position financing, but these are equity funds. And so investors who jump in and partner with us in those funds, they can participate in that. And, the draw here is day one cash flow, right? When we close on a property, it's cash flowing at, high single digits from day one. And, you can get there with other property types, but usually it's going to require a business plan to get executed. So people really like that piece. And then the funds diversify that single tenant risk that we talked about, right? Hey, how can we offset that? Well, a fund of 25 properties with 25 different tenants in different industries, so they're not concentrated, and that's very nice to have. Should we run into a vacancy, unlikely as that is, or even several vacancies, and still be able to support debt service. So it's a very nice vehicle for protection of capital, cash flow. And then over time, we're paying down debt. I know we didn't really get into it, but over time, paying down debt, NOI is going up every year, and investors get to participate in that. So it's a nice investment for those folks that are going, hey, I have some development investments, I have some heavy value add, but I'd also like something a little bit more on the stable, conservative side that cash flow is really healthy and has somewhat of a bit of reliability or a certainty around that cash flow that I'm not going to see a good quarter than a bad quarter. And,
Sure.
I've been an LP in some of these deals with other sponsors, and that's just the nature of it, right? You're going to have that with certain asset classes, and this really eliminates a lot of that. So yeah, we work with all kinds of high net worth individuals, small family offices. We have some wealth advisors that funnel a lot of their clients towards this product because they say, look, we want to get into industrial real estate. We're looking for some cash flow. We're looking for equity and appreciation as well. And this really checks all those boxes.
506C or 506B or?
Yeah, our funds are 506C, and we do one-off deals here and there that aren't a fit for the fund, and we'll generally have those 506B, and we can work with some non-accredited investors. But according to the name of the podcast, they're not listening, right?
I always say if you're a non-accredited investor, you listen, you're going to get a lot out of it. But our community is just for accredited investors. So speak to me, if you don't mind, just a little bit about the return and the term that an investor could expect.
Yeah, generally our funds, and I'll speak to those. They're 506C. We can talk about them a little bit here, but yeah, we're generally targeting 5-6 years in our funds. We're on our third investment.
Is your exit, is that through a refi and you guys will continue to manage, or are you selling, or what does that look like?
Typically a sale, right? You imagine 20-year leases, 15-year leases. You have, 10 to 15 years of lease term when you go to sell, and that's an attractive product for a buyer. Or portfolio of those where they go, look, we're looking at weighted average lease term and a diversified portfolio that has very like kind leases with annual rent bumps. And, they like to see that. So, a sale is really how we target an exit at a portfolio level, but we could certainly break it up if we need to. But yeah,
Is that usually like a private equity firm that's buying that, or like what type of a buyer is going to buy a portfolio of that?
yeah, it could be a REIT, it could be a very large endowments, private firms, investment firms, a large family office. Our first two funds, I mean, we're talking about today or at purchase price, we're a little short of 200 million in assets for each one of those. So, at sale in 4 or 5 years from now, it's coming up already, 3 or 4 years, you may see, 200 plus million in assets where these guys want to be as far as transaction size. And so we've had two funds we've raised, fully deployed, stabilized. We're currently at our third fund, which is a little larger in size. But, as we continue to grow, we keep targeting a larger portfolio, larger properties, but really the same execution strategy, right? As far as investor returns, generally we're targeting, mid to high teens IRRs on all these. And the cash flows, generally we're targeting 7 to 8%, right? We go, look, this is our target. We'll do as best as we can. But what's nice is we've been able to buy even in the low interest rate years and the high interest rate years, because really we're looking for a spread between cap rate and interest rate. So we want, positive leverage, right? We need to cash flow from day one because this is stabilized, right? I'm not going to have some construction project and raise rents later. We need this pencil from day one. And generally, again, this is an alternative financing instrument. When interest rates rise, we're able to buy these properties at higher cap rates, right? Because the seller's going, well, what are my alternatives, right? The Fed raised rates, cost of lending is higher as well. So we've been able to maintain that spread, and it's been a great last few years. All the previous stuff we've owned is just fixed rate financing, cruising along as they're supposed to. And all the stuff we're buying is a historically pretty high cap rates, and still today. We're talking in the 8 to 8.5% cap rate range. That'll come down, I'm sure, over the next 12 months. But what's great on the back end of the interest rate cycle is that typically these cap rates can lag interest rates a little. So, hey, we built in 1.5, 2 points of spread between, and as we're moving towards closing, Fed cuts rates once or twice more, and maybe your fixed rate locks in at closing, and now you have a fatter spread there, a little more yield. So I'm really looking forward to seeing the 6 months in front of us, 12 months of acquisitions, and seeing some fatter spreads.
Sure. Wow. The typical deal size, like individual deal size, what's your typical like capital outlay for that?
Sure, 10 to 30 million. That's the sweet spot as far as purchase price goes. We've gone higher than that. We've gone lower than that. But, most of the transactions we do are in that range.
And the debt to value is 70, 30 or 80?
Yeah, I mean, in the funds we manage, we've averaged about 65 to 68% LTV. But yeah, we're not afraid of leverage here because we have the stability here, right?
Yeah, definitely.
Family, you don't want 75% leverage on multifamily. I would take it on a single tenant net lease property, though. We're mindful of the whole portfolio and say, look, we want a conservative leverage overall. But yeah, you see the right deal and a bank is willing to get you more leverage there, you're certainly going to do well on the back end with that. And frankly, again, you don't have these day-to-day variances. So you got too much leverage, and then you have your multifamily property, a few people all leave at the same time. You got a few CapEx expenses that you can't ignore that come up, and all of a sudden you are, negative DSCR. You're diving into reserves, and you're going, I hope we can get through this, right? This is certainly a different case.
Yeah, no, I think that's a very good point when you think about leverage and just the overall demand of the product and how your leases are structured and all. I think that makes a lot of sense. So how does the fundraise? If you got to deploy 10 to $30 million, you guys have to be raising a good amount of capital because, like you said, you can't be missing out on a deal. If you're going down that path of this is looking promising, you guys have to have the capital to do it.
Yeah, I mean, as a fund manager, there's a little art to that, right? You're raising capital, and I mean, at any time in any fund, it's rare for any operator to have capital raising perfectly matching acquisition pipeline, right?
Well, the stars align. Now, I always say it's the dance between capital and acquisitions. It's always a dance, and there's no perfect way of doing it. Right?
Yeah, and we've been on both ends of that, right? We've seen capital moving faster, commitments in faster than, and that's always usually a good problem to have. Especially you have investors that understand, hey, be patient for a moment. We'll call your capital, and maybe it's going to be 3 months from now, but you're going to have ownership in a really nice portfolio of industrial assets. But on the other side, yeah, it creates a little problem where you're saying, okay, I guess we're going to maybe look at some smaller deals, right? Capital commitments are coming a little slower. So, I mean, I've seen, even in the same 12-month period where capital is moving really slow out there and then it's moving really fast. I saw it in 2023, right? Late 2023. The Fed indicates, hey, we're going to cut rates. I think they said 4 times next year. I don't think they knew exactly when. And then treasuries dropped. And all of a sudden, capital raising we saw from our experience, I mean, it just started flowing. Right. And then fast forward 3 months, right? The Fed goes, okay, inflation is not under control, right? It started to tick back up. People got really worried. Treasury yields went right back up and everything slowed back down. So yeah, there's a lot of investor sentiment that affects that. It's mostly that, frankly. But also the last couple of years, there's a huge amount of or pullback in liquidity, right? I mean, you and a lot of your listeners here probably invest in a lot of deals. And I think I've heard of, 1 or 2 deals in total from all of my investors that I've talked to. Let's say they had a deal exit. Right? No one sold anything. And why would they? Right? Perfect sense. But, typically investors, especially with a larger size portfolio, are used to many in deals exiting every year, right? And they're redeploying capital and a little bit of transactional volume that's just not there, right, to ask. So I think we're going to see a pick back up in the next few months, which will be nice. I think everyone's looking forward to some exits. And actually, even us, we have a few deals that we're looking at an exit over the next, Q4. We'll be returning investor capital with yields, and I think people will be really happy because they haven't seen that in a couple of years from anyone.
Yeah, you make a really good point there. And, in my funds, you have a really good group of core investors. And for years, it's just continual reinvestment. And I've seen that slow down a little bit. And and when I talk to people, they're not getting those quick sales that they were getting a few years ago, where they're in a project and it's 12 months, it's less than 24 months, and that property's selling. It seems like those days are in the rear view for now, at least. And, projects are taking longer, and, 3 to 5 years have moved to 5 to 7 and even beyond in some cases. So it makes you have to dial up your fundraising and that kind of stuff in order to do what you have to do, to get deals done and that kind of thing. So, definitely a good point there. Drew, how do people find? Exactly. Yeah. Yeah. Oh, yeah. Definitely.
We're going, I want a rate cut and I want a presidential election and I want, a good feeling and all 3 of those things. And now I'm going to start writing checks, right? I don't blame them, right? They just want certainty out there. And so I think, towards the end of this year you're going to see a lot of people starting to loosen up their grips and start to go, okay, I feel a little more comfortable as a country. We're moving in the right direction. I know what to expect a little more. And even the first rate cut was like, okay, we're there. I think most people know that if the Fed goes back up in rates, it'll just create mass confusion and uncertainty. And so, I mean, that's just my opinion, at least, that, they're now dedicated to the down cycle. And if that means they pause and don't cut for a little while, that'd be one thing, but they're not going to go back up for a while. They're going to sort of keep that trajectory, whether faster or slower, we'll see. But I think we got that sign now, and now we're moving.
I completely agree with you. That makes a lot of sense, and we'll continue to look. But I feel like there's a lot of the evidence is pointing in that way, right? How do investors learn more about Mag Capital?
Yeah, they can reach out to me directly if they'd like. My email is drew@magcp.com, or they can go to our website, magcp.com.
What's MAG stand for?
Originally Mitchell Asset Group. So 2 founding principals partnered about 10 years ago, but Dax Mitchell, the founding partner, Mitchell Asset.
That makes sense.
was it. So he had a brokerage before that as Mitchell Asset Group. So we just kind of transitioned to MAG at Capital Partners.
Gotcha. Well, that's always good to know. Well, Drew, I really appreciated you coming on the show and talking to me. This was a very insightful conversation around industrial and the opportunities that MAG have, and just a good look into a unique aspect within the industrial asset class. So I appreciate you taking the time, and I hope we have our mastermind as well. I'd love to have you come on sometime and get a deeper dive in, and bring some investors on, and we can have a conversation around it. And I'd like to just continue the conversation.
Yeah, it's been a fun conversation. Love to come on to any of the groups you have. I can talk about this stuff all day long, as you might be able to tell. I said, look, if you got 2 hours for your podcast, I'll fill up 2 hours if you want. But this has been a great conversation. I appreciate you having me.
Thanks, Drew. Great to have you.